we're going to present to you some information about tax around the world. We will be covering 5 countries. Loshni will be talking about New Zealand and Australia, myself Emily, Sweden, Fraser, the United States, and Josh, Monaco. We will cover tax rates, how tax revenue is spent, and views towards tax in each country.
The reason we chose this topic is due to the importance the role of tax plays in the relationship between a government and its people, and to view how culture affects that relationship. As a matter of interest, I have chosen our beloved country New Zealand, as Emily has introduced, and our neighbours Australia to make some comparisons. Taxes are collected by the Inland Revenue Department on behalf of the government in New Zealand, and in Australia it is levied and collected by the Commonwealth Government. Firstly, we take a look at the individual tax rates in Australia compared to New Zealand for the 2014-2015 income year. Both countries have what we call a progressive tax system. It was rather surprising when I made the comparison of those on the low income tax bracket that I found that the tax rate is actually nil for those in Australia who earn income up to and including an amount of $18,200 per annum. And looking at New Zealand, low-income individuals are taxed at a rate of 10.5% when they earn up to and including an amount of $14,000 per annum. The income tax rates for companies are at a rate of 28% in New Zealand. And as we can see from the slide, that the rate for companies in Australia are taxed at a rate of 30%. So companies in New Zealand are better off by 2%. Capital gains tax is a tax that has to be paid on the profits of certain assets when sold. An example of capital gains tax is John is employed full-time in New Zealand and he owns a house in which he lives. At some stage, John gets a lucrative job offer in Hamilton. He then decides to sell his house. Due to the demand of the housing market, he sells his house for $400,000. So John has made a profit of $100,000. He can then smile on the way to the bank as this profit of $100,000 that he has made is tax-free. So in New Zealand, people who are in a similar situation as John are fortunate enough not to have the capital gains tax. But had the similar scenario occurred in Australia, then John will be obligated by law to pay a percentage of that profit since he has made a capital gain. What are the taxes spent on usually? Where does this money go to, one might ask? In New Zealand, the taxes are spent on health. Majority of medications are subsidized for residents. An example is if a diabetic patient gets a prescription from the doctor, he takes the prescription to the pharmacy and only pays $5 per item for his medications, as the rest of the money is funded by the government. There is also free healthcare upon referral from a doctor at public hospitals for residents. Funds are also allocated to the accident fund known as ACC. This is when someone has an accident, they are covered by this fund. And be it for their stay at the hospital, surgery if required, and even for them getting a portion of their pay when they stay at home during recovery after they have had an accident. Funds are injected also into transportation, maintenance and repair, as well as construction of infrastructure. There is also a benefit for those who are unemployed, and these are just a few examples of what the taxes are used for. In Australia, there are certain similarities to New Zealand. However, in Australia, there is no accident cover for non-work related injuries. This means that only accidents or injuries occurring at work are automatically covered. There is a Medicare levy, which is a scheme that gives Australian residents access to health care. the resident taxpayers pay a rate of 2% on their taxable income. In New Zealand, whenever you have an accident, you are covered irrespective. Public perceptions in both countries. Due to human nature, it is natural for us to complain. Just like the capital gains tax in Australia is a bitter pill to swallow for those who have to pay taxes when they have a gain on the capital. On the other hand, New Zealanders feel that they are better off with not having a capital gains tax. With regards to the goods and services tax, known as GST in New Zealand, we are taxed at a rate of 15%, while our neighbours pay 10% on goods and services. And this causes some dissatisfaction to New Zealanders when we see what our neighbouring country is paying in comparison. So everyone has their own opinion on one subject matter or the other, and it will never be possible to please everybody at the same time. In this respect, the high income earners feel that they are paying too much tax. However, Kiwis feel that we should also be like Australia, and those on a low income tax bracket should not be taxed just like in Australia. On the other hand, the low and middle income earners are of the opinion that the high income earners should be taxed at a much higher rate, due to the belief that the rich are getting richer and the poor are getting poorer. The effects of tax on culture, which is tax cheats. This can be tax evasions or tax avoidance activities, which in my opinion is generally associated with the rich and powerful and involve large companies and big money. Yet the offence can also apply to ordinary people, to almost anyone in fact who derives an income and has an obligation to pay tax. An example of this is an article found in the New Zealand Herald. A Tauranga man has been sentenced to 6 months home detention and 150 hours community service for tax evasion. John Cox was sentenced on 8 charges of tax evasion when he was found that he falsified his client's spreadsheets by deleting his client's income details and filing false GST returns without his client's knowledge. This caused an understating of their income by $326,600 and overclaimed expenditure by $129,360 on other GST returns. In Australia, the way this problem is curbed is through a project called Project Wickenby. It is a joint agency task force that was created in 2006 to better identify fraud and build tax evasion cases. Since this project has started, they have succeeded in achieving 44 criminal convictions, collecting over $545 million in owed cash. With regards to the quote from the IRD spokesperson, I fully concur with Mr. Goggin. In my opinion, taxes are for the good of society as a whole and for the betterment of the country. It is for the citizens to enjoy and gain the benefits through the tax system, and thus individuals should not escape their tax obligations, as it is certainly not ethical to do so.
The country I have chosen to speak briefly to you about today is Sweden. Not only is Sweden known for ever and IKEA, but also their high tax rates. Sweden has a progressive income tax. As you can see here, these are the tax rates from 2014. Sweden's personal income tax rate averaged 56.28% from 1995 to 2015, reaching an all-time high of 61.40% in 1996 and a record low of 51.50% in 2000. So what do the high tax rates allow for? It allows citizens to send their children from kindergarten to college without ever having to pay a tuition fee, seek medical attention without worrying about their wallet, and have a comfortable retirement without having to shop for the best insurance. Sweden follows a progressive state pension system, so the more you earn, the higher your pension will be. There is also no fixed retirement age. high taxes allow children to have health insurance even when they're not working yet, go to school with subsidised transportation, sometimes even free, and have a monetary allowance from the government until reaching the age of 21. It allows parents to have at least 12 months paid parental leave from work. So how do people view tax in Sweden? Swedes don't just tolerate tax, they welcome it. A growing number would even accept higher tax if it meant for a largely fair, well-functioning society and decent public services. They are happy to pay high taxes because they know they are getting value for money later on. Most people trust the state manages taxes well. There is a broad and deep faith that the money is going to the welfare of the state and will be employed usefully. The Swedish word for tax is skatt, with another meaning being treasure. There can't be many languages in the world with such a positive connotation for tax. Despite the mainly positive views towards tax in Sweden, there is still tax evasion. It is considered a very serious offence with the possibility of jail time. They will hound you for the rest of your life for full recovery of the money at all costs. They have the right to seize assets, bank accounts, investments, properties, vehicles, furniture and clothing. This is the one area of Sweden law which is very good and heavily enforced. The tax office have no time limits on the pursuit of the money owed. They are required to pursue until death and seize the estate upon death if all debts are not yet collected. Now we hear from Fraser.
We're talking about the United States of America today. So as you can see here, we have one of the most iconic skylines in the world, and that is of New York City. But just how much you actually know about the superpower giant in the world today, just how much you know about their tax system. And that's what I'm here to hopefully enlighten you about today. So what you do need to know first off is that the United States tax system is very big, it's very cumbersome, it's very unwieldy, it's very complicated and unintuitive in how in comparison to other countries today. One such example of this is that in New Zealand we have goods and sales tax automatically included in the price of our products. However, in America they do not have the GST tax already inclusive upon their prices, so you have to add that on top of what you're already paying or what's displayed. Much like in New Zealand, employers withhold taxes from payments from their employees to make it easier for them to file their taxes. However, even though they have this starting point, they do still have, the employees themselves still have to claim that this is what the deductions are already made. However, if they don't do this, then they're breach of their tax liabilities already. As a result of this, the tax system in the US requires a huge amount of input to be kept running, and there are a certain number of deadlines throughout the year which has to be met. For example of this, on the 11th of January, so it is one of the first major deadlines, and that is if you are in a job which earns this money largely via tips, then you as an employee have to file a form called 4070 by the 11th of January. If this is not done so, then you are in breach of the contract. Another example of this, on the 29th of February, businesses must submit a form called 1099 or 1096. These are about business transactions that aren't tips or wages, such as hiring a contractor. But this is only, you have two separate forms, one if you're filing in paper or one if you're filing electronically. They're not, unfortunately, the same, even if it is the same subject matter. Now on to the actual tax rates themselves, when that is. As you can see here, there is a bunch of different categories which you can fall under, which makes it, at the moment there are currently 5 different categories, but this is very fluid at the moment, and it's very easy to get confused when you're doing it. On top of this, there is also standard deduction rates. These rates, much like the tax rates themselves, apply depending on your situation as an individual. If you're married, if you're single, or if you're a spouse, etc. These deductions are taken off straight away from the amount of tax you pay every year. And on top of this, even though you have the standard deductions which are taken off, you have the individual deductions which could be taken off if you meet some of the following conditions. For example, if you are blind, if your spouse is blind, if you're over 65 years of age, or if your spouse is over 65 years of age. If you have these, you can take a further deduction. However, that expands even further, and that if you're married or if you're single, you have two different rates for it. On top of this, again, because everyone loves how complicated the tax system is, if you are single, you flat have a $1,400 tax reduction straight away. Just like Australia, the United States of America has capital gains tax. This is, as Lodging has already explained this, I'm not going to explain what the capital gains tax actually covers, but so in 2015, the United States government spent $3.7 trillion throughout the year. Of this money, $3.2 trillion was paid for by the taxes of the members of the state, and the rest of it was paid by loans. Of this tax spending, 24% of this was spent on Social Security. This is amounted to $888 billion. This was provided mainly monthly retirement benefits to retired workers, their spouses and children, and any surviving children and spouses of deceased workers. Disabled workers and eligible dependents also covered by the Social Security tax. 25% of this $3.7 trillion, which is $938 billion, was paid to the health insurance programs. This largely covers either those who are disabled or those who are over 65. Unfortunately, unlike New Zealand, there isn't really any ACC in the United States. $602 billion was spent on the defence and international security system. This is a bulk of this reflects the underlying cost of the Defence Department itself, and also this also includes the cost of supporting operations in Afghanistan and other related activities. This funding was $74 billion for that. The safety net program put in place by the government kept 38 million people out of poverty based on the census done in the United States in 2015. It is calculated that if these systems weren't in place, the poverty rate would have been around about 27.3% versus the actual 15.3%. Now, what do people actually think about their tax system in the United States? Based on the national survey with a small number of people, so it's a grain of salt, however, it does show the underlying views. 64% of those surveyed think that corporations aren't actually paying enough, and 61% say the same about wealthy people. 44% of those people asked believe that the complexity of tax system is just too great. To give you an idea of what corporations are paying for taxes, we've got the slide above. Just to give you some context while you're looking at these, Level 3 is a telecommunications and internet service provider. United Continental is an airline. American Airlines is an airline. GM stands for General Motors, which trades in the automobile industry. And Hewlett-Packard is an information technology company. 40% of the people surveyed believe they're paying too much, and 53% believe they're paying just the right amount. The tax system gives the impression that the country itself operates on every man for himself system, with opportunities to increase their own personal benefits with careful tax planning and structuring, leading to sometimes bizarre tax scenarios in which you can literally be owed tax even though you made a profit. Just a strict review about a lack of medical coverage, but by the government, unless you exist in a sweet spot from which support does exist. We were asked the other day, the question was, what are the problems that can be caused by the difference of tax rates in different countries? So, one of the main issues if you're an accountant and you have to deal with tax rates, it just means you have to change how you do your tax calculations depending on what country you're in. This means you have to do quite often an extra course as you go through to actually be qualified to do an accountant in each country. Now, on to John.
While most societies shape their tax policies based on local values, there are places where it is the tax that shapes the culture of the country instead. My name is Joshua, and I'll be telling you why Monaco is one such place. The Principality of Monaco is one of the few remaining city-states left, despite being the second smallest country in the world, which is actually located inside France geographically. It still has its own monarchy and set of laws. In 1968, the Monte Carlo Casino was opened on the orders of the royal family. At this point in time, Monaco was deep in debt. However, with the collapse of the Second French Empire, the laws that previously stopped a diplomat such as the Prince of Monaco from operating a gambling house were now gone, and taking advantage of the new French railway, they finally had a way to clear their debt. The Monaco casino thrived and created a new pull in the tourist industry, allowing for the country to attract greater business ventures, dig itself out of debt, and start reinvesting in infrastructure. It managed to open the Oceanographic Museum and the Monte Carlo Opera House, and this casino was so successful that 11 years later, in 1969, Monaco could afford to abolish income tax for its citizens. Since then, the lack of income tax, and often business tax as well, has reshaped the face of Monaco. While it was already a tourist spot, it has now become a very attractive place for the super wealthy. Seeking the obvious opportunities, much of Monaco's industry began specialising in high-end products in order to cater to and profit from their new rich citizens. The previously already booming hotel industry became even more expansive and luxurious, and jewellers increased in number fivefold. Providing the best for the right price has become a national speciality. Government policies on tax now reflect how the money flows in Monaco. With income tax and business taxes only presented as exceptions, they still have a 20% value-added tax rate. This, like our own GST, allows them to gear their taxes towards buyers rather than sellers. As almost all business in Monaco is geared towards tourists and the super rich, this allows the ordinary citizens to operate at a minimal tax rate while the government generates income from others. Modern Morocco's population is comprised of roughly 30% millionaires and billionaires. It has the world's most expensive real estate, has the world's highest GDP per person, and the only nation to get higher than 1 on the Human Development Index. It also has record lows of unemployment and poverty rates. Monaco is an anomaly in the relationship of tax and culture, but clearly demonstrates how fundamentally they can shape each other. Taxes help to guide the citizens of Monaco to enrichment and show them a clear path to what it has become today. It has become clear over research in this topic in general of tax and culture that taxes are a reflection of the people at large. In small countries where the government is trusted, taxes are allowed to, and even encouraged to be high, as there is a belief that the government is responsible and she'll take care of them as long as they provide enough funds. In larger countries where there is a need for self-reliance and taxes are geared towards evasion as opposed to inclusion, there's often a feeling of distrust and disconnection from the central federal government. Altogether, this means that for ourselves, going forward, it is really up to us to decide whether we trust our government enough to increase taxes and provide greater benefits to ourselves, or whether we feel that we would be better served by keeping that money and providing for ourselves. Thank you very much.